Hey everybody, Dr. Diamond here, and in this video we're going to talk about how your company metrics are a lot like cooking. So in cooking we have these tools, right? So whether we're baking and measuring, whether we're cooking meat and we're measuring temperature, we have these tools to let us know if we're on track, to let us know if we are more likely going to get the necessary and the expected outcome. So we use tools to help us, and the same applies for business. And so many times I find that people do not understand their business metrics. So in this video, we're going to talk about the average lifetime customer value, how you find it, why is it important. So the average lifetime customer value is basically like what it sounds. It's the average amount that a customer that purchases your product spends with you. So if you have a $25 product, a $1,000 product, and a $5,000 product, let's say these are the three different offerings you have. You might find that a lot of people buy your $25 product and some of these other higher ticket items, not as many buy. And so if you average up, say there's 100 purchases of a variety of different of these mechanisms, you average up the total made, it was over 100 people, you take the total made, divide it by the number of clients, and then that you get your average customer value. The reason why this number is super important is say you do this exercise and your average customer value is $150. That for every sale you make, on average, it brings you $150. Obviously, some higher, some lower. But what this allows you to do is it allows you to make sure, one, that your dollar amount that you're charging is high enough to cover any time that it takes to deliver the product, right? Because you want to make sure that any time, any hard cost expense, such as website, or if you're doing products, any of the actual hard cost that goes into the products, all of that comes out of that $150 line. And the rest of that is your profit. And so what you can do when you understand this number is you can actually then determine how much you can spend on marketing. So depending upon the business you're in, a lot of businesses can wind up spending 20 to 30% in order to acquire a customer. If you are in a business that has absolutely zero, or I should say next to zero overhead, you might be able to push that number a little bit higher. But when you understand this, you understand, okay, the average customer basically makes $150 for you in this example. Let's say you run a marketing ad. And that marketing ad, let's say you spent $1,000 and you got 2 clients out of that. Now, whether or not those 2 clients, whether or not that's a profitable model, depends upon your average customer value. So if you run a $1,000 ad and you got 2 clients out of it and your average customer lifetime value is $150, obviously that ad is going to make you lose money, and you should shut it down, because if you basically acquired a customer for $500 and you only made $150 off of them, that's a loss. Now, if you find that your average lifetime customer value is, say, $1,500, and you ran the same ad and spent $500 per customer, then guess what? You would actually then have a profitable ad. So whether or not an ad is profitable, whether or not a marketing technique works, is based upon how much money you spent acquiring a customer from that ad and how much you profit on average per customer. So that's why you need to understand your average lifetime customer value. And then just like cooking, right? Just like your cooking metric, just like your cooking tools, this becomes a tool of how you can run your business in life. Again, I'm Dr. Diamond. Make sure you subscribe to this channel to continue to get lots of this sort of information. Information about my business coaching is down in the information below. I help women scale their businesses while staying attuned to their pleasure centers. See you next time.